Let's go back to 1965. It was the year when the Vietnam War was escalating, the Beatles were dominating global music charts, and Muhammad Ali knocked out Sonny Liston in their famous rematch. From a business perspective, General Motors was the largest listed company in the United States, and Microsoft wouldn't even be founded for another decade. So here's an interesting question. What would $100 invested in 1965 look like today? This chart tracks how that $100 would have grown across several major asset classes: stocks, cash, government bonds, corporate bonds, real estate, and gold. In the early years, equities led the way. But during the 1970s, gold surged following the oil crises and rising global uncertainty. Gold has traditionally performed well during periods of economic stress. By the 1990s, however, equities began to pull ahead again as global growth accelerated and technology companies began to reshape the global economy. There were setbacks along the way, including the dot-com crash in the early 2000s and the global financial crisis in 2007. However, the long-term trend remained clear. Fast forward to today, and the difference between asset classes is striking. A $100 investment in the S&P 500 in 1965 would now be worth roughly $43,480. That's a 435-fold increase. Over the same period, stocks delivered 29 times the return of cash and around 5 times the return of gold. The lesson is simple. Over long periods of time, compounding can dramatically transform invested capital. For more insights such as these, please visit our website www.csquareprivate.ie.